All right. Good morning and welcome. I am Dan Wilson. I am the Scientific Director of Financial Markets Regulation in the School of Public Policy here at the University of Calgary. And we are the sponsors of the research program in collaboration with the Alberta Government, Department of Treasury Board and Finance, that has initiated a number of research projects focused specifically on looking at issues and projects in building the financial sector in Alberta moving forward as part of the government's overall diversification strategy. So arriving just now is Dr. Jack Mintz, who will be sharing a few words of introduction. While he's getting ready, I'll read the land acknowledgement. I'd like to take this opportunity to acknowledge the traditional territories of the people of Treaty 7 region in southern Alberta, which includes the Blackfoot Confederacy, comprising the Siksika, Piikani, Kainai, and First Nations, as well as the Tsuut'ina First Nation and the Stoney Nakoda, including the Chiniki, Bearspaw, and Wesley First Nations. The city of Calgary is also home to the Métis Nation of Alberta, Region 3. And we acknowledge the lands on which we stand. Jack, I'd ask that you come give an introduction on behalf of the Financial Sector Partnership and introduce our speakers today.
Right. Thank you very much for everyone for attending, and those both in person and through the webinar. Anyway, it's a pleasure to have an opportunity just to say a couple of thank yous to both the Alberta government, who we have this partnership to look at financial markets in Alberta, but also the Power Corporation that has provided matching funding so that we can move ahead with a series of papers that are looking at how to build a stronger financial sector in Alberta. I think Dan has already explained a little bit about the reason for this, but I just wanted to give a bit of a background. The idea actually germinated when I chaired the Alberta Premier's Economic Recovery Council, and that time there was an identification of different sectors that could be significant, let's say significant sectors to add to the growth of Alberta and improve its diversification, of which financial markets was identified as one of those sectors in the government's economic recovery report. And it was at that time I thought it would be a great opportunity for the School of Public Policy to move into a clear and a really detailed study of what this could mean for Alberta and what opportunities there might be in terms of growing its financial sector. And in fact, a lot of people found that to be a very interesting idea, including the Alberta government. And as a result, we got a great deal of interest in moving ahead with that. And I was very pleased that Dan Wilson has been able to take on the directorship of the program with his, and he's done a terrific job in putting together so far many papers that we were having to come out of. These are the two that we're being discussed today, were the first two papers to be published, and we've already published a second one on open banking. We'll have a future seminar on that as well. And there will be further ones to be coming out over this coming year and next year as we complete the program. So this is pretty exciting to move ahead with today's program. And I'm very pleased that we have two of our papers that are being presented on captive insurance as again an important opportunity for Alberta. We're going to have the speakers. The two papers are Anne Kleffer and Eric Johnson, who focused on the regulatory issues around captive insurance, and Michael Dosen, who will from Flesky Flynn, who has done a very detailed paper on tax implications associated with captive reinsurance as well. In addition, we will have some comments from Sam Jackson, Vice President, Captive Management, NFP Canada, with some comments about, about the two papers and implications, and we'll have an opportunity for a question answer period to follow. For now, I'd like to invite David Mullock, Government Executive Director, Pension Insurance Policy of Alberta Treasury, to provide some background on the changes that are already taking place in Alberta with respect to captive insurance.
Great. Thanks, Jack, and thank you, Dan. I'd like to start by thanking the School of Public Policy for hosting today's session and for inviting me to provide some opening comments on behalf of the Government of Alberta. I think it goes without saying that we are very, very excited about our new captive insurance legislation in the province, as we feel it presents an excellent opportunity to grow our financial services sector and help contribute to economic diversification in our province. In short, we feel that the papers published through the Alberta Financial Research Partnership are impressive. They are comprehensive and instructive, and we feel they represent valuable and provide valuable contributions to our captive insurance governance. Although the papers were published after our Captive Insurance Companies Act came into force on July 1st, we did have the privilege of reviewing earlier drafts, and we were aware of the quality of the contribution that they were providing to the discussion. Additionally, we were working with other stakeholder groups, and it was nice to see that the feedback from those stakeholders was being matched by the advice and the suggestions and the thoughts within the draft papers. So it helped us to know that we were on the right track in developing the legislation. And in fact, even now, the paper that's authored by Anne and Eric is helping to instruct our regulatory group on how they will treat the capital expectations for captive insurers that choose to operate in Alberta. As you may know or have perhaps already heard, we do have our first licensed captive insurance company up and running in the province, but that is only the first of what we expect to be as several more. A wide range of organizations in Canada and from offshore captive domiciles have approached us with expressions of interest in setting up in Alberta. When developing our act and regulation, we spoke with other jurisdictions and reviewed the examples found in captive insurance legislation from BC, several United States, several states within the US, and multiple offshore jurisdictions. Our goal was to create a best-in-class and also made-in-Alberta solution. Our captive program isn't just aimed at Alberta businesses. We are ready to welcome captives from elsewhere in Canada or from other jurisdictions that do not already offer their own captive programs. And while Alberta isn't the first province in Canada to offer captive insurance solutions, our goal is to be the leader. Alberta is truly open for business. We believe our province is well positioned by having one of the most competitive corporate tax environments in Canada, and indeed perhaps within North America. And furthermore, we do not charge a sales tax on insurance premiums like you see in other jurisdictions across this country. Welcoming captives to Alberta is, in my view, a logical extension that builds on our existing and strong financial services sector, and it can help further support growth and innovation. Now, all that said, our captive insurance regime is in its infancy. It is, and will continue to be, a work in progress. We don't envision that what we have now is the last word or that it's written in stone. Instead, we do want to see our captive insurance regime grow, adapt, and change over time to provide the best possible environment in which to do business. That's why sessions like the one today are important. They help contribute to future improvements that Alberta can make to our captive insurance legislation and governance in this province, ideally allowing captives to thrive. I look forward to the discussion today and the presentations from the co-authors of the papers, and would like to again thank everyone in attendance for the interest and this exciting opportunity. Thanks.
Thank you, David. I'd now like to welcome Dr. Ann Kleffner, Chair of Insurance and Risk Management at Haskayne School of Business, to speak first, and she'll be followed by her collaborator, Eric Johnson, co-founder and lead underwriter he'll give the correct term of MIC Global in London. Thank you.
Okay, good morning, everybody. It's nice to be here and happy to be here to talk about the new Captive Insurance Act in Alberta. I'm going to just take a few minutes really and give some brief overview of captives and the captive environment and some of the trends that are making this the right time for Alberta to do this. And then Eric is going to follow with some more specific comments around the regulatory components and what we believe will make this a successful endeavor. So just to begin, the Captive Insurance Act that has been passed in Alberta, if you want to just essentially just allows companies to establish what's called a captive insurer. And a captive insurer is owned by a non-insurance parent, specifically for the purpose of providing insurance to the parent and its subsidiaries. And why this is done is that it's a more cost-effective way to insure their risks. And these were first started back in the 70s, basically in Bermuda when the insurance market was quite tight. And this movement, if you will, has grown quite a lot over time. So there's essentially three types of captives. The first type is a pure captive, which is owned fully by one parent and provides the insurance just for that family group. The second type is a group or association type of captive. And these are centered around, for example, an industry association, possibly a union, professional associations. So they are formed as a group in terms of insuring essentially the members within the group. And then the third major type is a segregated account or protected cell captive. And what we're seeing right now in the broader captive environment is a lot of the domiciles that are looking to attract companies to their domicile are making it possible to set up segregated account or cell captives, but because it actually accommodates the needs of smaller and medium-sized enterprises better, because they're not establishing their own captive, but there's a sponsored cell or a sponsored captive whereby each cell operates as if it's an independent one and their liabilities and assets are separate. So those are the three main types, although there are other types, but that gives you a sense anyway of the primary forms of captives. This perhaps looks too busy to actually talk about, but I'm just going to make the comment around the fact that the thing to remember with a captive insurer is it does everything a regular insurance company does. And so it pays it receives premiums, it writes policies, it pays claims, it complies with the regulations. But the one thing that makes it quite different from a regular insurance company is it doesn't have the same usually third-party risks that a regular insurer would. So the interest in terms of solvency of the captive, or if the captive were to have some issues, it typically would not have the same implications from a policy standpoint or a public interest standpoint as a regular insurance company. Because again, most of the time we're talking about a captive that is insuring their own risks. So that's one of the, I think, the interesting things for the regulator to decide, and that is from a capital and solvency standpoint, what is an appropriate level of safety and solvency strength for a captive when they're not, in fact, a public-facing entity. In terms of the captive insurance market, it has become very competitive over the last while. Right now, there's 29 states and the District of Columbia that have domiciles just in the states alone. And all the captives vary to some extent in terms of their regulatory environment, their capitalization requirements, et cetera. And so Eric will talk about what it is that tends to attract companies to different domiciles, and particularly the things that really drive decision-making. And about 6,000 captives were operating worldwide last year in about 70 domiciles. And the top ones are Barbados, Bermuda, and Vermont. Most Canadian captives typically have been in Barbados, although more recently Bermuda has become a much more popular destination for Canadian companies. And I'll mention too that BC has 21 or 22 captives, whereas Barbados and Bermudas have more like 600. So there's a big difference there. But an interesting thing is that most of the new Canadian captives are being formed in Bermuda, actually. So Bermuda has taken over some of the competitive market from Barbados. So this is just to show that from an industry standpoint, there's really no one dominant industry. All different types of industries use captives. So in terms of size, in terms of sector, in terms of risk profile, captives can be used by many different entities and used effectively as a way of managing their cost of risk. And then finally, just in terms of some of the trends that are, again, I think I can remember the conversation with Dan and Jack initially, and there are things afoot, if you will, that are making things perhaps more costly and more difficult for companies if they're going to operate in places like Bermuda and Barbados. So a big one being the increased cost of compliance to comply with economic substance legislation, and also BEPS, or base erosion profit, I should say, shifting and not sharing. And so it's just more costly for companies to comply. So that's been an issue. A really important one is the insurance market conditions. And so for the last couple of years, the premiums have gone up, availability has gone down, and companies are looking for more flexible ways that they can transfer their risk. And a captive is one way to do that. There are also concerns around looking for opportunities in Alberta, the energy companies who are finding it harder to place their insurance because of ESG concerns by insurers. And this also gives companies more flexibility in terms of their insurance program. So a number of different reasons why I think the shop window that Eric will talk about, it's a good time for Alberta to hang up its captive sign. Yeah, so I'll turn it over to you.
Yeah, thank you very much, Anne. So I'm gonna talk a little bit, and Anne's already given away my favorite slide, which is about the shop window and the beauty parade. You'll get to see later on. Thinking about the things that companies look at when they're looking to establish a captive, what are the key decision factors they look at? You know, I've done a bunch of captive studies in my career, and the list can be as short as 5 to be as long as sort of 15 different things that they look at. But the primary one that I've seen companies really drive their decision is, you know, where is the company's parent based? So, and because that usually drives their insurance premium tax requirements as well as their income tax requirements. Where are the risks that captive is insuring based? Because again, that drives what kind of regulatory regime they need to be able to satisfy. The captive regulator, and what I mean by that is how flexible, how experienced, how credible, how fast is the captive regulator. We can't ignore taxes. So, you know, corporate taxation is it, well, a lot of captive owners will say that captive decision making over the captive's domicile is not based on tax. But I think, as Anne highlighted, the largest domiciles tend to be in jurisdictions where there is nil to very low tax. So tax, from my experience, is a very big driver on where a captive gets set up. And then I think the fourth one is capital insolvency. So what I mean by that is, what is the minimum amount of money that a captive has to have in their bank account to be able to trade? And then the solvency is sort of the buffer that a captive has to hold to be able to pay all their claims without a reasonable prospect of them failing. Sorry, next slide. So when you look at where the captive owner is based, so this can drive a couple of things. One is really basically the travel cost requirement to travel to a board meeting. So if you can believe it, in my experience, we've looked at saying, okay, this captive domicile is going to take you 16 hours to fly to for one board meeting. It's going to cost you this much, and you need to do 4 board meetings a year, versus this domicile is in the state next door. You don't need to do 2 board meetings a year, so you're not going to have to give up that much time, because your captive board meeting is usually your risk manager on it, but also your CFO. So it does take time and cost to travel to these places. And I think, as Anne mentioned earlier on, there's increasing sort of a reputational challenge, right, of companies saying, what, you're traveling to the Cayman Islands for a board meeting, and then also there's the ESG elements of it. So companies are starting to look at things like this. And then there's What are the accounting standards like? Do they align with your local, where your company's domiciled? And then the location of where your insured risks are will drive your insurance premium taxes. So different domiciles around the world, depending on where the risk, if you've got a factory in the UK versus a factory in Alberta, you will pay different insurance premium taxes based on that. So there will be a driver about where is the most effective place to have your captive to minimize your insurance premium taxes, as well as the need for a fronting company. So what that means is in certain domiciles, you will need to have, if I'm a captive based in Barbados, but the company I'm insuring is based in, say, Mexico, I may actually need to be a licensed carrier in Mexico. So I will pay an insurance company a fee to sort of trade off of their regulatory permissions, and they will front the program for me, and then they will reinsure it back to my captive. But as you can imagine, that takes care of a regulatory burden, but that fronting company takes a cost. There's a fee to that. So where you can find a captive where you can minimize fronting costs can also be attractive. And then when you look at the captive regulator, what I'm thinking about here is sort of we talk about reputation and credibility. So this is the next slide. And then when you look at that, it tends to be how many captives do they have in their domicile? You know, if it's a very, very big domicile, clearly they're credible and they've got the ability to get it done. That demonstrates their experience with captives. As a captive advisor, when a client comes to you looking about where they want to set up, you want to be able to advise your clients. So you want the regulations to be transparent, right? So I want to be able to say in a nice grid format, these are the key requirements of doing business in Alberta. This is what it's like in Barbados. This is what it's like in British Columbia. So that I can very quickly advise the client, but where is the best place to set up from a high level perspective. I think fast and efficient is key. And I liked actually the way the Alberta government has worked. I think they've got a 6-week timeline. So being able to get your application in, get it reviewed, have a pre-meeting with the regulator, and then get feedback very quickly. Because there are domiciles out there that claim to be able to turn around a captive application in several weeks. So you want to be able to have a very fast and flexible regulator, approachable. And I think Alberta has done this, inviting people to come and have a meeting with their regulator before you even send in your application to say, this is what I'm looking to do. What are your thoughts? What are the hurdles we need to overcome in our application before it even starts? Because there is nothing more frustrating for a client than sending your application in. 6 weeks later, you get a no, and then you have to start overcoming hurdles. And if you had known some of those hurdles at the very beginning, you would have addressed them in your initial application. And I like the way that Alberta talked about being sort of, this is not set in stone. So I'm calling this collaborative and flexible. So I've seen domiciles around the world where the captive regulator will have a sort of a practitioners panel. So people who own captives and people who run captives of managers that regularly advise them on trends that are taking place around the world to ensure that they have the most flexible, efficient, and I guess well-regulated market that they can that still retains a competitive advantage. I think on the next slide, when it comes to taxation, this is an interesting challenge, I think, for companies in the Canadian context, because the homes of most Canadian captives, being Barbados and Bermuda, operate a sort of a low to nil corporate income tax regime, and tax treaties can make it quite attractive for a company to have their captive in that domicile. And if you compare that to Alberta, where there will be an income tax component, that is a driver in where a company looks to set up. Some domiciles have withholding taxes. So when you're actually trying to repatriate your profits through a dividend, that can also be a hindrance to having when you're looking at which domicile to select. And then there are also some captive domiciles, not very many anymore, that will actually have a capital tax. So your original share capital to sort of capitalize and start your captive will incur a tax. So those corporate tax is a key driver on where a company looks to set up their captive. And I think the final consideration on capital and solvency, I think this is somewhere where Alberta does have flexibility. And we have had very good discussions with the Alberta government on this, and we covered it in our paper. There's 3 levels of capital, the way I look at it. There's the minimum capitalization. So that is, to be able to be a captive insurance company, you have to put X amount of money in the bank. And that is there, in my view, to cover the extreme event of insolvency. And then there's the next level of capital, which we know regulatory surplus or solvency capital. And that is there to protect policyholders to be able to make sure that there's, 95% of the time, if a claim comes in, there will be cash there to pay out the claim without any risk of insolvency. And then most captives actually hold it in excess of that number because their capital requirements will also be driven by the reinsurance that they buy. So if you're a captive and you're buying reinsurance, your reinsurers will have quite a big stake in how much capital you hold. If you're using a fronting company, which I mentioned earlier, your fronting company will, because they're buying reinsurance from you, will want to make sure that you're financially sound. So having, in my view, having a minimum capital and then a solvency requirement that is competitive with Alberta's key domicile competitors, which I view as being Barbados and Bermuda, is very, very important. But then also having the flexibility to work with the regulator to say, I'm writing a very unique captive. So I might be writing a captive that only does long tail lawyers' liability negligence insurance. That's a very unique class of business. The formulaic approach that Anne and I presented in our paper, that might not be the most suitable approach to the captive. So actually, let's work with your regulators, come up with a bespoke capital model that'll work for that unique risk. But I think having, in my view, having the sort of the window that says this is what the minimum is, this is the capital requirement, this is the solvency requirement, but also having the flexible approach is working with your regulator to come up with an approach that might work best for your captive, that still reduces the risk of insolvency is very important. I think this is my favorite slide, which is the Alberta shop window. And this is me trying to summarize things in a humorous way, but when someone comes to a captive advisor and they say, where should we step our captive? They will come and they'll say, oh, I've heard that, Bermuda, Barbados, Bahamas, the Isle of Man, Malta are really attractive domiciles. So then some junior consultant will create a grid and look at travel cost, minimum capital, minimum solvency, corporate income tax, insurance premium tax. And they will have that on the grid and they'll look at how that might impact a captive writing, say, $100 million of premium. And that can be done quite quickly. And most captive advisors have already got all this data readily available. And that's what I say is having an attractive shop window. And I purposely picked Alberta in the winter there, and Bermuda and Barbados in the summer. And this is how, at the very first stage of where an advisor looks at where should we step a captive, they will come up with a long list. They will assess it against a bunch of criteria, which can be subjective, and then come to a short list. So I'm saying Alberta needs to have an attractive shop window so that you are on that short list and you're also on the long list. And then what tends to happen after that is what I call the beauty parade. And here I've shown the Calgary Stampede. So you might have whittled your 10 captive domiciles down to 3. And then you will say, okay, let's do a deep dive into this. Let's actually calculate the solvency capital that we think you're going to have. Let's look at your corporate structure and let's really figure out the corporate income tax implications for your company versus just the headline corporate income tax rate. And then what you often do is you will have calls with the regulator, those initial calls that Alberta said they're willing to have, saying, this is what our plan looks like. This is what we think the capital looks like. This is what we think the regulatory regime is going to be. What are your thoughts? And then from that beauty parade will be the selection of a captive domicile. So if you go to the next slide, I've done a very simple one, and I've got Alberta in red, but I'm very confident that we're going to move some of those to amber and green. But if you look at reputation, Alberta's new to this game. So if you're trying to sell Alberta as a domicile, how do you change the reputation and the experience and the service dynamics from red, where I think there's a few captive managers to have set up, to amber and green? Then there's some relatively simple ways, and I think Alberta's already got some captive managers that have been formed, which is great. And then looking to recruit captive regulators who are very experienced in captive regulation from some very competitive domiciles, I think would really help Alberta. You look at speed to set up, actually, I think Alberta is very competitive on that. You look at travel, well, if you're based in Canada or Alberta, well, it's green, because actually I didn't realize how difficult it is to get to Barbados. Though it's a nice place to go, but it can take up to 16 hours. So if you've got a board meeting there 4 times a year, you are really taking people out of the working environment. And you'd think that that's not an important factor because really everyone likes to go there. But if you're an executive and you're out for 4 days every 4 months, it actually does have an impact on your productivity. Income tax here, we are competing against Barbados and Bermuda, who've got very low income tax. We've got premium taxes that need to be paid. We've got minimum capitalization. I think the one where Alberta really has an opportunity to be different and innovative is around the minimum solvency requirement. So that's that amount of capital that you have to hold above your initial share capital. And I think as long as Alberta is competitive with Bermuda and Barbados, we do have a real opportunity to attract captives here, because some of those ones that are red, I'm confident will turn green. But I think a real decision factor will be around how much capital a company needs to hold. And actually, I think I've covered off the rest of my slides, if you can believe it, in my conversation. So I'm going to stop talking.
All right. Thank you very much, both of you. And we will now turn to Michael Dolson. Michael is a partner at Pulaski Flynn, one of the leading tax boutiques in Canada, formerly in the Edmonton office, and as of the last year, having opened up the Toronto office. So joining us today from Toronto.
Thanks, Dan. So I'm going to be talking about the taxation of captive insurance companies and specifically how this will work with Alberta. This is going to involve some of the most complicated tax rules in Canada and some of the more rapidly changing tax rules internationally. So there's a lot to get through. This is going to be extremely superficial, but as you've heard from the other presenters, very important in captive locating decisions, because ultimately, if the tax doesn't work, it's not going to happen. So we can go to the next slide, please. The starting point is that there's really two sets of tax concerns. One is there's a set of tax concerns that you have with Canadian businesses that want to do captive insurance, and there's a set of concerns that you have with foreign businesses that want to do captive business in Alberta or do captive business anywhere. And those are going to be, in some cases, very different sets of tax concerns. So, for example, for a foreign business, we care a lot, if you're trying to attract foreign business to Alberta, about the foreign jurisdictions, controlled foreign company regimes, and how that's going to interact with the Canadian tax system. The good news is that Canada, being a relatively high tax jurisdiction, we're whitelisted on a lot of countries' controlled foreign company regimes, or we just will qualify for some kind of a high tax kickout under their CFC regimes. So in that sense, Alberta is actually very easy, because it may be a red on the chart that the income tax rate is high, but if you like simplicity in terms of foreign country reporting, it's a green, because there's not much that you're going to have to do, because you're going to qualify for some kind of exclusion from their controlled foreign company rules. Next are sales taxes, specifically GST, HST. Again, this is a relatively simple point, is that there is not going to be any GST, HST collectible on the sale of an insurance policy by an Alberta captive, whether that's sold to a Canadian person or a foreign person. If it's sold to a foreign person, there may be some input tax credits available that would not be available with a Canadian insured person, but that's fine. As well, there's going to be some GST, HST reporting complexity, because you are going to have a selected listed financial institution as an insurance company, but that's relatively manageable, especially where the only permanent establishment of the insurer is in Alberta. Federal excise taxes, these are things that are potentially a big sticker item that Canada, and this is a concern only for Canadian businesses, that if you're trying to insure Canadian risks through a non-Canadian insurer, like in say Barbados or Bermuda, you would have this 10% excise tax on the gross policy payment to the unlicensed insurer. This is in practice worked around using fronting insurers, so it's not actually a practical problem, but it is something that you will need professional advice on. If we can go to the next slide, please. Provincial premium taxes are a concern. This is not a concern for non-resident businesses that are insuring foreign risks, simply because Alberta, like all other Canadian jurisdictions, we only impose premium taxes on insurance business transacted in Alberta, whether that's transacted by a licensed Alberta insurer or by a non-licensed insurer that is not soliciting insurance business in Alberta. But either way, like all Canadian jurisdictions, there's no premium taxes on premiums that are written for business outside of Alberta. So in a sense, we're very competitive on premium taxes because if you're not insuring Alberta risks, there's going to be zero Alberta premium tax. If we go to the next slide, please. Income tax, and income tax is the big one. We're not going to talk about withholding taxes, which were mentioned in the prior presentation, simply because there just isn't enough time to do that. And obviously, withholding tax rates depend very much on the treaty with the relevant investor jurisdiction. But there's income taxes driving the bus on all of this, right? And there's three main concerns with income tax. So if we can go to the next slide, please. Our first concern with income tax, and this is especially concerning if you have a Canadian group that is paying a captive for insurance, is that you want a deduction from the policyholder's income for the amounts that they're paying for insurance. This is a very easily managed point as long as you've structured your legal relationships correctly and you're not doing something weird like having the operating business guarantee the debts of the captive insurer. Then you should be fine. You should get a deduction. Legal advice is required, but it's easy enough to manage. If we can go to the next slide, please. This is the bigger item, and this is for Canadian groups that are trying to do captive insurance, is that you have significant risk that if you have a foreign insurer, that your insurance income is going to be imputed back to Canada as foreign accrual property income, or FAPI. This is a very adverse result versus having a Canadian captive insurer, which would pay tax on the insured's income at active business rates. If you have tax on FAPI, the rate is going to be at some kind of a property income rate, which if your ultimate parent entity is a Canadian controlled private corporation or a CCPC, then you're going to be paying taxes about 52.3% on that FAPI. So it's a huge swing from a 23% active business rate in Alberta to a 52.3% rate on FAPI. So something to keep in mind. So to get into the FAPI web or to have a good foreign captive, first of all, you have to manage residence of the captive. And this is what was spoken about when in terms of having board meetings in the foreign jurisdiction. That's why you're doing this, is to manage residence, because central management control of the captive has to be exercised in the foreign jurisdiction in order for it to not be resident in Canada. If it isn't resident in Canada, then you're looking at if you have a foreign affiliate, and if you have a foreign affiliate, you have a controlled foreign affiliate. So like it says on the slide, generally speaking, as a rule of thumb, if you own more than 1% of any class of shares, and if you and all other people who are not at arm's length with you own more than 10% or more of the shares of any class, you have a foreign affiliate. If you have a foreign affiliate and you control it, or you would control if certain deeming rules apply, then you have a controlled foreign affiliate. And if you have a controlled foreign affiliate, you might have FAPI. Canada has recently enacted what we call tracking affiliate rules, which were meant in part to defeat offshore captive insurance arrangements, which actually helps tilt the playing field in Alberta's favor here. By causing foreign affiliates that would otherwise not be controlled foreign affiliates to be deemed to be controlled foreign affiliates, which generally is causing with these offshore insurance arrangements, especially group captive arrangements for car dealers, et cetera, to be swept into the controlled foreign affiliate regime and to cause FAPI imputations for, in this example, the car dealers. So if we can go to the next slide, please. At a high level, when does insurance income become FAPI? Well, if you are insuring in a foreign affiliate, if you have a foreign affiliate that is insuring Canadian risk, that's going to be FAPI. If you have a foreign affiliate that is insuring the risks of other foreign affiliates of the same corporate group and that are earning active business income in whatever other jurisdictions the other foreign affiliates are carrying on business, that's not going to be FAPI, and you'll get a very good result in that case, especially if you're, for example, deducting from income earned in, say, France and having your income pick up instead as premiums for an insurance policy in Bermuda. That's a very good result. But that's the rule of thumb here, is if you're insuring Canadian risks in any way, insuring, reinsuring, acquiring under an insurance swap, any of that kind of stuff, you're going to have FAPI. And it's especially if you have a CCPC at the top of the chain, it's going to be a very bad scene. Next slide, please. If you are going to have FAPI, having loss reserves is very important. And the loss reserves are just the amount that the insurer is entitled to deduct from its premium income, so that only the net premium income is actually subject to tax. as long as you want to make sure that your loss reserves are being computed correctly and that you're able to take the largest possible loss reserve if you're going to have a FAPI pickup. Next slide, please. So what are people doing in other jurisdictions aside from the income tax point that most captive insurance jurisdictions impose zero tax? Most also impose zero premium tax. Again, this isn't really a very competitive point for Alberta, given that we would impose zero premium tax on non-Alberta risks either. Where this is an important point is that in some jurisdictions, the residence of the insurer dictates the premium taxes and who pays premium taxes and at what rate. And so if you can be resident in a jurisdiction with no premium taxes, that's potentially a significant win. If we go to the next slide, please. Here's what's changing in the international landscape that's making things very interesting. You heard before there was a reference to BEPS. This is a significant change for large multinational groups that have offshore captive insurers. If they are in scope for BEPS Action 5, so first of all, and this is for everybody, BEPS Action 5, just that you're going to have significant economic activity in the jurisdiction where you have your captive. So you are going to have to shift all of your insurance management to that jurisdiction. For most people, this is probably not a huge deal because they were already contracting it out to insurance managers in the jurisdiction. But for people who had their CFOs, et cetera, managing the insurance business from Canada or from any other jurisdiction, this is a potentially a significant cost that's going to be imposed to ship that to the foreign jurisdiction. If we can go to the next slide, please. This is the big one for multinationals is Pillar 2. And so if you are in scope on Pillar 2 because you have a consolidated group with revenues over 750 million euros per year, then you're effectively going to be subject to tax throughout the world at a minimum rate of 15%. Assuming that Pillar 2 happens, there's currently some disagreement with some European countries are holding this up. So it remains to be seen if it will happen. If it does happen, this will be a huge playing field leveler for Alberta versus other jurisdictions, both for Canadian multinationals and for foreign multinationals, because now instead of having 23% versus 0, you now have 23% versus 15. So it does make things a little bit more interesting for Alberta. And especially if you think Alberta is going to be attracting business from Canadian multinational groups rather than foreign multinational groups, now they're at an 8% differential and they get to avoid all the costs of having the foreign affiliate in the foreign jurisdiction and avoid potentially having FAPI pickups, all that kind of stuff. So it makes Alberta pretty competitive without Alberta actually having to do anything. So go to the next slide, please. This is where we are in terms of opportunities. And I think I'm generally much more positive about there being opportunities to attract captive business from Canadian groups. Both Canadian groups that are not multinationals, that are smaller Canadian groups but could have a use for captive insurance, as well as from Canadian multinationals. I think there's a lot of opportunity here, given that for large multinationals who are in scope on Pillar 2, I think the fact that you get to have not a huge tax rate differential and avoid the cost of creating the captive makes Alberta very interesting. For people who are large enough that there's huge potential savings from insuring risk in foreign affiliates in a zero tax jurisdiction, and where you're not large enough to be in scope for Pillar 2, Alberta is probably not super interesting for people in that sweet spot. But for smaller groups where there might be an interest in captive insurance, now that you don't have to incur the costs of captive insurance and you're getting, not a bad rate, 23%, if you're getting some provincial arbitrage versus say 29% in New Brunswick, Alberta again looks pretty interesting. You save some money on your insurance by self-insuring through the captive, and you save some tax while you're at it. So that's an interesting opportunity. Like I talk about in the paper, there's probably not a lot of opportunity for retaliation by the other provinces, especially if there's not a huge amount of interprovincial base erosion. Could you attract more business from other provinces if you were to do something with corporate income tax rates in Alberta? Yes, maybe, but there's two problems with that. One is that you risk cannibalizing your own corporate income tax base, because it's very easy for Alberta companies that set up Alberta captives and then shift their income from the operating business to the Alberta captive. Number one. Number two, it does invite the potential for retaliation by other provincial governments or by the federal government. So, and you know, the policy rationale for any kind of tax cuts for captive insurance is not compelling, right? There isn't really a good policy reason why you would do this. So probably not going to happen. We can go to the next slide, please. International opportunities, you know, we assume there will be infrastructure at some point, so that's less of a concern, but you know, it's difficult to see whether Alberta would ever be truly competitive versus foreign jurisdictions for captive business. If you can pay 15%, even if you're in scope on Pillar 2, pay ultimately 15% in Bermuda versus 23% in Alberta, and you're already in Bermuda or the Cayman Islands or Barbados or whatever, it doesn't make a lot of sense to shift to Alberta. So you're probably not going to see very much happening here. Again, to make Alberta competitive, you'd have to eliminate the provincial income tax on captive insurers. And there's, again, not a very strong policy rationale for doing that. So I think that's all I want to say about tax. That's your overview of the Canadian tax regime for foreign affiliates in 15 minutes. And so I'll kick it back to the big room.
Thank you very much, Michael. At this point, I'd just like to say a special thank you to our three authors here today. As you've, I think, become aware of very quickly, these are truly world-leading experts in this space. Their engagement in this project was not because they lacked other opportunities that were more lucrative or had higher profiles, but because they had a true desire to contribute to the future of this province. And you know, we are grateful for the research budgets that we're able to provide some support, but that is certainly not the foundation, you know, in which they participated. You know, those were indeed very small numbers in the grand scheme of things. I think there was some attraction in this particular case to being able to speak directly to government and directly with government and partner with government in a very live conversation in real time as the regulatory regime was being formulated. And as David mentioned, to be able to have the drafts of the papers in the hands of the policymakers being consulted as they went through the process of coming up with the detailed regulations. But thank you for your time, which is very valuable and greatly valued on our part. We turn now to a very interesting piece, which is the industry thoughts on the matter. And we're very fortunate today to have Sam Jackson. As David mentioned, we have a first to the post captive insurer in Alberta. And David was intimately involved in those efforts. He is with NFP, and I'll turn it over to David to speak to the industry position.
Sam.
Sorry, Sam, thank you. Thank you. And I turn it over to Sam from NFP to speak to the industry response to the both the papers that we've heard today and the opportunity that lies before us. Go ahead, Sam.
Thank you. Yeah, so I started my career back in 97 after graduating from the University of Calgary program, and worked in risk management. I've worked with a reciprocal alternative risk financing vehicle for oil and gas for several years, and had the opportunity to work with regulators for many years of my career, and recently started with NFP to set up our captive management portfolio. And our focus is really to help clients and assist them in setting up their captives here and take advantage of the new legislation. We were very fortunate to work with a client that was very eager to set up an Alberta captive. They have captives in other domiciles and see the benefit of having licensed paper for their Alberta risks. I agree with the authors here that setting Alberta up and believing that we're going to be a domicile of choice again for international business is maybe a little bit of a high expectation, But for Alberta companies and hopefully Canadian companies, we can be that domicile of choice. Premium taxes, I would suggest, are going to be, it's going to make a difference for Alberta companies with Alberta risk if we are competitive with other jurisdictions that have zero or fractional premium tax for risks within their domicile. So I've suggested, and I've talked to our regulators several times on the importance of evaluating that premium tax benefit, and which would hopefully encourage some of those companies that have captive domiciled in other jurisdictions to re-domicile and bring their capital back to Alberta. The experience I had in setting up the first Alberta captive, we were very eager. So our application, pre-application, I guess, showed up with the regulator 3 days before they were prepared. And we knew that it wasn't a complete application, but we wanted their comments and to work collaboratively with them. And David Sorensen and the group there were very good to work with. Within 2 weeks, we had some response back to them on some things that they wanted to see. We knew there'd be some holes in our application. And by August 1st, we'd completed the application. And really within 6 weeks of being able to license a captive, by the 10th of August, we had a licensed Alberta captive. So I think, great work with the regulators, and the flexibility of working with them was well, incomparable. They are open for business. I know that working with other regulators in Canada, the Alberta regulators have always been the most effective and efficient in doing their jobs. It wasn't a painless process, and I can't say that all of the questions I felt were necessarily relevant, but they weren't hard to answer, and they were very good to work with. Capital requirements are still something that, with the captive that we set up, our client had sufficient capital that they overcapitalized. They were well over the minimum capital, well over any solvency issues. And so that wasn't even part of the conversation in whether or not, how do we do this? I know with other companies, as we go forward, that's going to be a bigger issue, and the Alberta government is prepared to, and has been in contact with my colleagues on this panel already on how do we make that work and make it attractive for those companies trying to set up captives. As far as going forward, what's going to make Alberta a domicile of choice is we've got to have opportunities for corporations that's going to incentivize them to come to Alberta and set up. And that is, like I said, premium tax, I think, is going to be important, the corporate tax treatment, and the capital requirements. So all of the things that Eric has outlined, I don't think I can add any value to that presentation. Economic substance within Alberta and trying to set up bring clients here and more business to Alberta. Without strict rules, we risk having all of that business being done in more established domiciles, where the captive managers in Vermont or Barbados or others, where they've got the experience and the knowledge there, can still do all of that work, because the financial sector is pretty easy to do from a computer. So you can do it anywhere in the world, and without any economic substance rules in Alberta, that's potentially what can happen. And I think we've got to look at ways to make sure that people are working in Alberta, capital is being deployed here and used here. So those are my general comments. I think the question and answer period will be an opportunity to put in some more comments as they come in.
Thank you, Sam. So we're doing extremely well on time. We've actually stayed on the timetable, which leaves an excellent amount of time for questions. And now it is over to you here today live and those participating online. This is where you drive the agenda, and I'm hoping that you will have a number of questions, and it can be for any of the panelists. I think also you could certainly ask questions of David on the government side, who's still with us. So any questions at all? And for those of you who are online, if you write your questions in the question form component, we will have them read out here in the live room. So who will be first? Dr. Mintz.
Thank you for the excellent papers that you prepared. I do have one question, which I have, after even reading them, I still was a little bit puzzled, and that is, as Anne and Eric mentioned, Vermont is the third largest center for captive insurance, and I'm still trying to understand exactly what happened there and why that occurred. Maybe I don't know enough about U.S. tax law, but I would think that a federal tax still applies there, and if not for a state level tax. And maybe there's no premium tax, and maybe there's some good regulatory reasons. And of course, it's surprising that it's Vermont as opposed to Delaware. that is an attractive place for captive insurance. So I was just wondering, maybe Eric and Ann, if you could give and maybe Michael on the tax side, if you can give an explanation about why Vermont took off so much.
Yeah, I can speak to the regulatory part, not the tax as much. Vermont, I know in the US there was a big push probably about 15 years ago on the regulatory and the tax side to encourage businesses to move their captives onshore. But I'm not a tax expert, so I won't touch what caused that. But on the regulatory front, they invested quite heavily in a very slick regulatory regime. So they have a practitioner panel. They regularly update their captive legislation, so it can happen almost every 2 years. They will be looking at ways to make sure that they are competitive with the best of breed domiciles. If you go to any insurance and risk management conference, they're there. They are out there plugging Vermont as the place to have your US captive. And then their regulatory insolvency regime is relatively competitive. But I think where they've really invested is on the regulatory team and the infrastructure to make it fast, efficient, flexible, and collaborative. And I think that would be my contribution to that. But on the tax side, I'll hand over.
Yeah, for sure. So Vermont is more competitive than you would think on the tax side. Even with the seemingly high US federal tax rate. And a lot of it is just shifting income to avoid state tax. But obviously, first of all, like in Canada, insurance companies get reserve deductions in the United States and fairly significant reserve deductions. So a corporation is a licensed insurer, may not actually have to pay tax at an effective rate on 21% of what its real income or income otherwise determined under regular rules would be. So that's a bit of a starting point, but it is generally in intra-US shifting from other states to Vermont, especially from higher tax states. The US did tighten up their controlled foreign company regime to make non-US captive insurance not very attractive, and with excise taxes on premiums paid by US persons for US risks to non-US insurers. So there's also an excise tax component there too that you have to keep in mind. But what Vermont does is they eliminate state tax on their captive insurance companies. There's only a tax on premiums, which are, unlike in Alberta, they do tax premiums basically everywhere, no matter where the insured risk is. The premiums are taxed in Vermont, but at a very, very low rate, and there's no state tax. So, even if you assume you're not going to get out of the federal tax web, then you might get, as say, for example, a deduction against 8% state tax in California and pay effectively 0% tax in Vermont. And that's a relatively cheap thing for an American corporate group to set up. So that's the attraction of Vermont. It's in large part state tax management.
Thank you, Michael. We have another question from the floor. I would ask everybody just to provide your name at the start of your question.
Sure, it's John Horseman. Yeah, it's interesting. Thank you, Jack, for your intro. My observation, just in terms of what we're trying to do here, is Western Canada, especially Alberta, has a history of being very capital intensive, right? So we consume a large amount of capital to grow our economy and generate our prosperity, but we don't have any capital here, and so we're always going somewhere else for it. And so and most of it's in the East. And so as we think about growing this industry, it's also about growing capital pools here that can strategically benefit the businesses that we do. And that also now starts tying closer to the parents. And so I was curious, in your paper, you didn't really talk about, and I think this is something that's very real. You talked about ESG, and that's important, but what's sitting underneath this, as I was understanding, is I was watching oil and gas companies not being able to get insured, D&O, et cetera, oil field service companies not being able to get insured, watching the pipeline companies not being able to get insured, the construction companies constructing the pipelines not being able to get insured, the manufacturers now driving the component parts for the, for those industries also not being able to get insured. And so you got this real massive curtailment of capital that's kind of moving across. And so you got potentially a situation where Alberta, Western Canada, mining companies, resource-based, economies aren't going to get insurance. And at the same time, you got a structural curtailment of capital. And so one of the thinking parts, I think, of this was also to create the pools of capital, the investment opportunities kind of located in the same jurisdiction in which people operate. And I think that's going to play a bigger role, especially as all public companies have to do these disclosures. I think Barbados and Bermuda are now going to start curtailing their capabilities to finance and insure these core industries that drive Alberta agriculture and oil and gas. And so maybe just talk about that. I get the tax, I get the premiums, I get all the, the grid, but there's also a strategic component I think is going to play a big role in why this is going to work in Alberta.
I'm just going to make a brief comment, and then I'm going to see if Eric wants to add to it, which is the issue around ESG is a tricky one in that even if companies obviously can set up their own captive insurance companies, they can retain part of that risk in-house through their captive, but it doesn't solve the problem of typically captives by reinsurance, right? And the large reinsurers were the first ones really to start waving the ESG flag and withdrawing capital from the market, or capacity from the market. And so the idea of having an Alberta pool of some sort, perhaps made in Alberta solution, so to speak, that supports the energy industry in a way that will really address those problems that you're talking about in terms of the availability of insurance, is one of the things that I think you first were thinking about as well. And a group, maybe you're part of this group too, right here. Yeah. Because I agree with you, that's a bigger problem to solve. That's a much bigger problem to solve.
Yeah, and I'm based in London, and I look at the London context, and I was saying to my former classmate, we're driving into the city today, about not sort of a month goes by where a big London insurer or European insurer saying they're getting out of X. And as an Albertan, I sit there in these meetings thinking it's odd, because in the UK and Europe, we're struggling right now to pay our heat and electric bills. So I do think there's possibly some scope, and I know that the Alberta legislation is about the sophisticated insurer sort of mechanism, which I think is sort of around reciprocals and pools, if I'm not incorrect.
For sophisticated, that's an interesting term, the sophisticated captive, where we considered licensing as a sophisticated captive, but didn't feel that there was any real understanding of what that meant, either for the regulators or us. So we're a peer captive. They're working on that. We're working on what does that mean and how is that going to make.
Because the way I looked at that, and I read that a few times, the way I was thinking, is that a mechanism where you think you could create you could have a bunch of Alberta-based energy, mining, construction captives who then purchase reinsurance from a mutual-ish they own themselves, as a way of further creating and deepening a capital pool. But I wasn't like you, I wasn't completely sure what that meant. But I do think, coming from the European context, I think that problem's only going to get harder. You know, the inability or the unwillingness of reinsurers and insurers to do this kind of business that Alberta does, I think is going to get tougher. I know Lloyd's of London several years ago came out and said no more oil sands related assets. They made a big song and dance about it. 2 years later, at an ESG forum, they updated their policy. It's no longer there. But they never did a song and dance saying that the ban is now gone. So I think there's still a perception that it's not business that they want to do. And so I don't know how Alberta can solve that, but we sort of touched on it in the paper, but some form of Alberta-based mutual or reciprocal or some way of trying to retain and deepen that expertise within Alberta where we all share in the risk genuinely. I think that there might be a need for that in the future.
Yeah, unfortunately, captive legislation isn't going to solve the capacity issue.
Yeah.
A captive is a corporation's ability to take on their own risk, and it's sets up its own insurance company. It's another tool in the risk manager's toolbox to finance their risk. They're still going to want to transfer risk to that excess risk, and capacity for the excess risk is limited, and it's becoming more and more limited, and that is a significant problem. Captive legislation is not going to solve that. That's got to be something else.
Thank you, Sam. We have another question from the floor over here.
Great discussion. I like where this is going. Rob Shear, and just further on the last point, the initial discussions were initiated, I would say, by the Alberta industry, largely the Canadian Association of Petroleum Producers, and the ability to have, lack of capacity, lack of insurance as underwriters were pulling back and insurers were pulling back. Yet a lot of these exact same companies are global leaders in terms of the amount of investment that they're putting into carbon capture and sequestration, renewables, just transitioning overall. And I guess maybe the shop window comes to mind for you, Eric, or if it's maybe a better question for you, David. What can the Alberta government do to show leadership in, providing an incentive for companies that are on the right side of the ESG transition and making this firm commitment and investment?
It's interesting because I was at a conference last week put on by Aon in London, and they were speaking about having the first green captive. And I wasn't completely sure what that meant. But I spoke to someone at the break, and they were the first captive insurer to sign up to what's called the UN Principles of Sustainable Insurance. And so there is a framework that you can sign up to as an insurer. And actually, as a small company, it's very affordable to sign up to. And it comes with some reporting requirements, some governance requirements, and then a pathway to what you're doing. And it is not just on I always find ESG is interesting because people talk about E as if it's just carbon, right? There's trees, there's water, there's the earth. So actually you could be a captive that signs up to this framework. And then and that gives you a sort of a public facing way of saying to your reinsurers, possibly, we are committed to this. I am part of the Pathways Alliance. This is what we're doing to impact our E and the ESG. And the G part is we're part of the governance framework of the UN Principles of Sustainable Insurance. What the Alberta government could do around that, I'm not sure, but I do think having spoken to the people who did the first one, I thought that could be an interesting angle of trying to counter the availability of you've got the captive, so you're retaining a bunch of that yourself, but you still need to buy reinsurance. And if that market's shrinking, how do you differentiate yourself as a captive from any other captive that the market's sort of a little bit nervous about insuring at the moment.
And I'll
David,
just supplement a little bit. Thanks, Eric, very much for that. I think the question is probably more complicated than I can cover in my own little slice of what I have some ability to influence. But and in fact, I think the topic extends even beyond just captives. I mean, we heard from John and Ann and Eric about the capacity issue. I think the starting point for captives for me really starts from that capacity lens. And then, just it's getting more difficult to find insurance coverage that I need at a price that I can be willing to afford. And what could the government of Alberta do to help in that respect? So that was really the launching pad, I think, for a lot of this entire initiative, is to develop captive insurance legislation that allows largely maybe Canadian-based or Alberta-based companies at the start an opportunity to establish their own captives, to give them another tool in the toolbox that could frankly either complement rather than replace, but complement their existing insurance and risk management portfolio and tools that they have available to them. We've seen, I think others within the government of Alberta would say that actions that the government of Alberta is trying to do on the entirety of some of the things we're talking about here. We have the Climate Change Secretariat that the government of Alberta has established. We've seen a very concerted effort on both government and industry to try to position Alberta and Canada as a responsible producer of energy. And to the to the extent that my insurance policy team is able to help support those initiatives, yes, we developed the captive insurance legislation, not part of this presentation, but the government of Alberta also made amendments to its Insurance Act to allow for some unique opportunities, or I call them unique opportunities, to develop a reinsurance entity that would be Alberta domiciled. And I know some of the people in this room are familiar with elements of that initiative as well. And so there's a whole building block approach, in my view, on what government can and ought to be doing on this very complicated and complex topic. Thank you.
Thank you, David. We have another question from the floor.
We do have a couple of questions coming in online, so I'll read one out here. This is from Brian Livingston, and this was received during Michael Dolson's presentation, so I believe it's for him. From the Alberta government's point of view, is the target market non-Canadian companies setting up captive insurance in Alberta, or non-Alberta companies setting up captives in Alberta?
David, I think this is for you.
I will tackle it, but I kind of like the idea of putting Michael on the spot to speak for the government of Alberta. I think the answer to the question is we wanted to develop a legislative structure that allowed individuals to cast as wide of a net as possible. But in truth, I think the focus initially was there was no one particular segment that we were attempting to target per se. We had this general issue of a lack of capacity. There were, obviously, you think of the energy industry when we speak of capacity constraints, and what we've heard from John in the room, I think, around the withdrawal of capacity by large insurers and reinsurers. But it's not just an energy industry issue. We've heard from a lot of entities. They were explaining to us, and we were speaking with some stakeholders, that they have very proactive risk management regimes that they felt they were not getting the credit for that when they were speaking with their traditional insurance company, because the insurer did not understand their business. So having a captive available to them was, as I said earlier, another tool in the toolbox that will allow them to have more options at their disposal. And since, and certainly my regulatory colleagues can speak to this far better than I can. And Sam, I have to say thank you for those comments. David Sorensen will pass along a message to me that he appreciated those. But in some of the discussions we've had with stakeholder groups, it's ranged from energy, of course, as you would expect, forestry, tourism, medical, hotel and lodging. Like the interest in captive insurance has absolutely blown me away. And now, yes, well, a lot of people were in the tire kicking stage, but I do feel quite strongly that that's going to translate over time into actual action. There is work that is necessary to establish a captive. Folks such as Sam and other captive managers will help prospective clients through that process. We do have a very dynamic and engaging regulatory unit that is very eager to be able to help raise their game and change some of those red bars into yellow or ideally green bars. So a very long answer maybe to the question, but there wasn't one segment per se that we were targeting, but I think we've heard from speakers on this call, at least, that the large amount of interest, at least initially, probably will come from Alberta-based companies first, maybe Canadian-based companies second, and then potentially looking at things like redomestication of existing captives that are owned by Canadian firms. And then the fourth bucket would be, I'm a foreign entity that wants to set up a captive, and Alberta will be my number one stopping place to do that. Thanks.
Go ahead, Sam. Go ahead.
In order for Alberta to do that, and to I like Eric's comments on the red boxes, like we got to have experience. We got to have, in order to get the experience, we need the Alberta companies to support the Alberta captives. And in order to get the Alberta companies that already have captives in Alberta, we've got to give them a premium tax credit. We've got to do something to encourage them to do that. And right now they don't have any, there's not a lot of incentives in the current legislation and the current tax treatment for Alberta entities. So I think that's a big thing that should happen and needs to happen. The other thing is that the insurance group needs to be able to talk to the tax group and even the energy group. One of the biggest challenges I think CAP pointed out in their letter was that premiums paid to insurance companies, third-party insurers, are an offset on their op costs associated with paying royalties. But premiums paid to a captive aren't. Well, that's a huge penalty. And if we're looking to be able to provide capacity and allow them to take on more of their own risk, that formula needs to change and go back to what it was previous to 2017, where the royalty calculation is different. But that's different government entities actually talking to one another and making sure that happens.
Thank you, Sam. I'm going to go back to the floor for the next question before we take the next one online.
Hi, I'm Mike Suderman. I guess in terms of, aside from the strategy around unlocking capital and capacity for key industries or other industries, condo strat, whatever it is there a significant jobs component to onshoring kind of captive managers and that kind of thing and expertise? Is this a big sector? Is there a lot of people employed in insurance in Bermuda, for example, that we would be attracting? Just general to the panel. Anyone
well, I'll
answer?
hand over to you, but I did a project for a Caribbean country looking at exactly this. Captive management isn't a job heavy industry, but it's also not job light, and the skills and expertise, they're high paid finance jobs. So you will attract jobs to Alberta, and there will be a need for actuarial support, legal support, tax support, accounting support, insurance management support. And I think one of the things that when we were working on the paper, at least I was thinking about, and I was thinking about the redomestications, like how do you do a big bang in Alberta? How do you get that expertise, credibility? How do you get your first 20 captives? You make it very attractive for 20 captives from Barbados or Bermuda to move here. And my original thinking was, well, you do that by saying, we're going to make it very easy for you to redomesticate your captive here. For the first, say, 2 years, your captive can be managed by your current captive manager in Bermuda, Barbados, wherever it is. But then once that sort of grandfathering period is ended, you're going to use an Alberta-based captive manager. So you've got the jobs, the employment here, but then you've also got the mind and management and economic substance here. I'm not a tax expert, so I can't comment on how that would work. But I do. There are jobs. The amount of, if you get a significant amount of captives, you're going to get a significant amount of sort of support services that are required. But I think you, being a captive manager, can probably speak to that.
The financial, and that's when we started this comment, is Alberta's looking to, how do we build up our financial sector in Alberta? This is a way, but without rules to say you have to have employees here, it's ineffective. There's already jurisdictions that have captive management companies. They've got all the actuaries, they've got those things. Right now, I can think of maybe 2 or 3 actuaries that are resident in Alberta, because you can do actuarial work anywhere. We've got consultants in California that have a Canadian actuarial stamp, and they do their work from there. So we need rules to say, well, you have to do it here, but to encourage people to show up in Alberta.
On the extreme opposite side, though, in Bermuda, I mean, that's an enormous part of their economy and their employment. And they typically have a hard time actually recruiting and keeping people, and because they have pretty strict rules about Bermudians working there. So there is that end of the spectrum, but to get there or even, you know, make a difference, I think, yeah, there needs to be some different changes.
I would just add in from my own personal experience working in Bermuda, that if you go to the local pubs, you will find Canadian accountants and actuaries watching hockey games and curling every night of the week. I think your idea was very interesting, Eric, of inducing the companies to redomesticate in Alberta by giving a transitional period. The costs of keeping people, you know, in Bermuda are extremely high.
Yeah.
You know, by orders of magnitude, probably 2x per employee of what it would cost to have someone in Calgary.
Mhm.
A lot of people in Vancouver, a lot of people in Toronto and Montreal are, you know, looking at putting high value jobs in Calgary because of the cost of living and the attractive lifestyle and the perception of a young city with access to the mountains and the outdoors. I think a lot of those Canadians in Bermuda in a transitional period would be happy to come to Calgary, given a inducement to, you know, come here, but then have a period of transition in which they can move here and create employment here. Now, I know we had another question online, so we'll go to that.
Next online question is from Gord Tulk. How significant an impact would the creation of an Alberta pension plan to replace the CPP be, where the payroll tax rate would reduce from 10% to 6% in Alberta and the CPP rate would increase to 12%? So how significant would the impact be on the captive insurance industry in Alberta?
I think that's a question for Michael.
Yeah, I think it would make zero impact. The reality is, like, effectively what we're talking about is employer side payroll taxes, like in the form of CPP contributions or EI premiums. Given that most captives employ 0 people and contract all of their administrative work out to captive managers, this will make no practical difference. You know, it's really just a question of whether we have the captive management skills in Alberta is the bigger concern, which is not a tax point.
Thank you, Michael. Do we have any other questions from online?
Yes, we have a few other questions here. So the next one is, condominium insurance rates are soaring. Would a captive insurance vehicle be viable for a consortium of property management companies in Alberta or even Western Canada?
Looks like Eric and Ann have thoughts on that.
A captive, an association or trade association captive, that's actually how most captives got started. There was a capacity crunch that hit an industry, a sector, and there are a lot of sort of trade association backed captives where they run it as if it's a mutual insurance company owned by the members. They pool their resources, and you'll see a very clear trend between a hardening insurance market, so it's getting much more expensive, you're not getting the coverage you want, and the number of captive formations. So I think that is a very key growth area.
Yeah, captives can be set up for those types of entities. It's the risk bearing capacity and the willingness to put up the capital required to start and maintain a captive. Like, the challenge of a condo association is you're dealing with however many units are in that condo and the risk appetite of each and every owner as to how much they're willing to put in. But with higher premiums, everybody's saying, well, we can't, we want an alternative. Well, we can put together a feasibility study. We can show you exactly what the costs are and where the costs are going. But unless you have the capital and capacity to take on some risk, it's hard to do anything with it. Associations help because then you've got a larger base. But again, there's got to be some capital up front to set up and establish that entity and a willingness to take on some exposure.
Thank you. Next question.
Next question is from Martin Davies. What advantages do Alberta nonprofits have for setting up an Alberta captive insurance entity?
Anyone want to take a shot at that?
I can jump in on the tax side of that, which is that given that nonprofits tend to not have a huge budget for tax compliance, et cetera. Obviously having the ability to do an Alberta captive where you're not paying to fly your staff to Bermuda, et cetera, 4 times a year is a huge a huge cost savings. And as we would tell clients, typically is the cost of maintaining mind and management or otherwise maintaining a controlled foreign affiliate in a tax haven jurisdiction is probably $100,000+ a year. So the fact that you can pull that off, and again, it's a nonprofit. So you're probably it lowers the threshold for where a captive becomes viable for a nonprofit or a group of nonprofits, and the tax rate. Even if you can't structure the captive to be a tax exempt, which is theoretically possible that you could, you're at least not paying tax at an egregious rate at 23%.
Thank you, Michael. Any other thoughts on that?
I would suggest that a nonprofit would be very similar to any other entity looking at a captive. It is understanding your risk, understanding the total cost of your risk and where insurance makes sense and where some self-insurance and or a captive vehicle would make sense. And if it makes sense for a for-profit or not-for-profit, it's going to be the same process to understand that risk and make it happen.
Thank you. Next question from online.
Yes, so next question, and we are reaching almost the end of our time here, so we'll take this probably as the last question, is from Patrick Mattern from Calgary Economic Development. How important is the availability of skilled talent for captive insurance and the cost of that labor in the location decision?
I can speak to that. And I think Anne alluded to the costs of Bermuda talent being quite high. The cost of Isle of Man talent or Guernsey and the European cost is quite high. So it does factor because you will be, and a lot of captives will use a captive management company. And if you're paying a Bermuda style salary, but usually to hire expats and then a bunch of locals, it is expensive. And I think one of the unique features that Alberta has that I don't think is obviously well known is University of Calgary and the Haskins School of Business has got, I think, English Canada's only Bachelor of Commerce program with an insurance and risk manager major, but we also have an actuarial science program based in Calgary. So we actually have a pool of graduates that could very easily fulfill these roles. So it would be creating an industry to actually employ people who are training already in Alberta.
Including these two.
Yes, yes, we do have 2 illustrious alumni from that program today.
So yeah, and I think to Dan's point earlier that yes, the talent is here, and so creating an opportunity for those jobs is something to work towards.
Yeah, I did take some of the I graduated from the actuarial science program as well, and the options on where to become an actuary were east. There was nothing in Alberta, so this is an opportunity to develop that as a domicile. So some of those graduates have some options to stay here. I think there's 3 of my classmates that are back in Alberta, but nobody stayed here to start their career because there was no options.
Well, and I think on that point, we are now at our time limit. It was an excellent discussion. Thank you for those questions. Final thanks to our partners in this program, the Government of Alberta, Alberta Treasury Board and Finance, and also our sponsors, Power Corp. Thank you to our discussants today, our panelists, our writers. Special thanks to Michael and the team and David. And thank you all for coming. We will have more in the series as we move along. I hope you put out the good word. Thank you for your attendance. Have a good day.